Inflation era overview. High inflation becomes an everyday reality, and what used to be rare suddenly turns into something people experience constantly. Prices no longer stay the same for months or even weeks, but begin to change rapidly, sometimes within days. This creates a sense of instability because people cannot predict how much things will cost in the near future. Uncertainty spreads through society, affecting not only financial decisions but also emotions and long term planning. In this environment, traditional savings lose their meaning, and people start searching for ways to protect what they have. Gold slowly emerges as one of the most important assets, not because it is new, but because people rediscover its role as a stable store of value. Daily life changes. Fuel shortages and long lines become a visible symbol of the crisis. People wait for hours just to fill their cars, unsure if there will even be enough fuel left when their turn comes. Inside stores, prices are constantly being updated, and customers notice that the same product costs more each time they visit. Purchasing power declines, meaning that even though people earn money, it buys less and less over time. Families are forced to make difficult decisions, cutting back on everyday items and postponing plans they once considered normal. This shift affects not only consumption, but also confidence in the future, as people begin to feel that their financial stability is slipping away. Gold awakening. As the situation worsens, people begin turning to gold. What was once seen mainly as jewelry starts to gain a new meaning. Individuals who never considered buying gold before now see it as a form of protection. Gold becomes more than an object of beauty, it becomes a tool for preserving wealth. This shift in perception is powerful because it reflects a deeper change in how people think about money and security. In times of uncertainty, owning something tangible and universally valued provides a sense of control. Gold represents stability in a world where everything else feels unpredictable, and this realization marks the beginning of its renewed importance. Oil shock impact. The embargo causes a sudden and dramatic increase in oil prices, and because oil is deeply connected to nearly every part of the economy, its impact spreads quickly. Energy becomes more expensive, which means transportation, production, and even basic goods cost more to produce. This chain reaction destabilizes the entire economy. What starts as a problem in energy markets quickly turns into a broader economic crisis. Businesses struggle to manage rising costs, while consumers face higher prices in almost every area of daily life. The shock is not gradual but immediate, leaving little time for adaptation and forcing governments and individuals to respond under pressure. Stagflation emerges. At the same time, a new and unexpected economic phenomenon appears: stagflation. High inflation is usually associated with economic growth, while unemployment is linked to downturns, but now both occur together. This creates confusion because traditional economic theories do not fully explain the situation. People find themselves paying more for goods and services while earning less or even losing their jobs. The combination is especially difficult because it removes the usual solutions. Stimulating the economy risks increasing inflation further, while controlling inflation can worsen unemployment. This paradox makes the crisis more complex and harder to manage. Government measures. Governments respond with various measures, including speed limits, reduced work schedules, and campaigns encouraging energy savings. While these actions aim to address the problem, they often fail to produce the desired results. The measures can slow down certain aspects of consumption, but they do not solve the deeper structural issues in the economy. As a result, frustration grows among the public, who expect quick improvements but instead see limited progress. The gap between policy intentions and real outcomes becomes more visible, highlighting the difficulty of managing such a widespread and interconnected crisis. Policy responses. WIN program promotes saving, and it represents an attempt to solve an economic problem with a behavioral approach. Governments encourage people to spend less, conserve energy, and act responsibly, hoping that collective discipline will reduce inflationary pressure. At the same time, governments introduce price controls to limit how much businesses can charge for goods. Central banks also step in, trying to reduce demand by tightening monetary policy. On paper, these responses appear logical and coordinated. However, they rely heavily on public cooperation and assume that expectations can be easily managed. In reality, economic behavior is more complex, and people react based on what they believe will happen next, not just on official instructions, economic consequences. Empty shelves and black markets begin to appear as unintended consequences of price controls. When prices are artificially kept low, suppliers lose the incentive to sell, leading to shortages. Goods that are difficult to find in official stores often reappear in unofficial markets at much higher prices. Businesses, anticipating future cost increases, raise prices whenever they can, even before their own costs go up. At the same time, workers demand higher wages because they expect prices to continue rising. This creates a cycle where both sides try to protect themselves, but in doing so, they reinforce inflation. Instead of stabilizing the economy, these reactions contribute to further instability and uncertainty, loss of purchasing power. Money loses value in a very real and visible way. Households notice that their income no longer covers the same expenses as before, forcing them to adjust their lifestyles. Items that were once affordable become luxury purchases, and even basic necessities start to feel expensive. Saving money becomes a burden rather than a benefit, because the longer cash is held, the less it is worth. This shifts behavior dramatically, as people prefer to spend quickly or invest in assets that might retain value. The psychological impact is significant as trust in money weakens and financial planning becomes more difficult. People begin to question the stability of the entire economic system. Gold as safe haven. Gold no longer holds the status of official money, yet it rises in importance as a protection against inflation. As its price increases sharply, it attracts attention from individuals who are looking for stability in an unstable environment. The rise in gold's value is not just a market phenomenon, but also a reflection of growing uncertainty. People are not only buying gold for profit, but for security. It becomes a place where value can be stored without relying on governments or financial institutions. This shift highlights how quickly perceptions can change when confidence in traditional systems declines. Why gold matters. Gold cannot be printed, which makes it fundamentally different from paper money. Its supply is limited, and this scarcity gives it a sense of reliability. It is also globally recognized, meaning it can be accepted and valued anywhere in the world. This universal acceptance makes gold a practical asset during times of crisis. Additionally, gold is easily tradable, allowing people to convert it into cash or goods when needed. These characteristics combine to make gold uniquely suited as a store of value. In uncertain times, these qualities become even more important, reinforcing its role as a financial anchor. Human stories. People's experiences bring these concepts to life. Some individuals who previously had no interest in gold begin buying it as a form of security. For them, it represents peace of mind in a time of uncertainty. At the same time, other families are forced to sell their gold to cover essential expenses such as heating or food. These contrasting stories show that gold serves multiple roles. It is both a form of protection and a source of emergency funds. It acts as a financial reserve that can be relied upon when other options are limited. Through these personal experiences, the importance of gold becomes clear in a way that numbers alone cannot explain. Silver speculation. Hunt brothers buy silver, and their actions quickly draw attention across financial markets. Instead of treating silver as a stable store of value, they approach it as an opportunity for massive profit. Prices begin to rise rapidly as demand increases, fueled not only by their purchases, but also by growing interest from other investors who do not want to miss out. The market becomes increasingly unstable as more money flows in based on expectations rather than fundamentals. This creates a situation where prices are driven by momentum and speculation rather than real economic value. What starts as a strategic investment gradually turns into a widespread frenzy. Silver collapse. Silver Thursday triggers a dramatic crash that exposes the risks of excessive speculation. As margin requirements increase, investors are forced to provide more collateral to maintain their positions. Many are unable to meet these demands, leading to a wave of selling. Prices fall rapidly, and the market that once seemed unstoppable suddenly collapses. Investors lose significant amounts of money, and some see their life savings disappear. The situation spreads beyond individuals, affecting brokers and financial institutions as well. The event becomes a powerful example of how quickly markets can reverse when they are built on unstable foundations. Lesson learned. The difference between safety and speculation becomes clear through this experience. While assets like gold can serve as protection, speculative behavior introduces significant risk. Markets are inherently volatile, and even assets that are considered valuable can experience sharp price swings under certain conditions. This teaches an important lesson about financial discipline and the dangers of following trends without understanding underlying risks. Investors begin to recognize that not all opportunities are equal, and that the promise of high returns often comes with equally high dangers. The story of silver serves as a warning that emotional decisions in finance can lead to serious consequences.